is going, and then let me make sure I'm sharing my screen. I think that's good. And then, all right, so my goal today, I have two people who asked me to go over their data. So I'm going to be going over a lot of data, but I want to start with, I'll talk a little bit about my silver prediction, my gold prediction, and then SPY as well. I'm going to end up looking at, this is my old intraday watch list that I used to have, but I don't really use it as much anymore. Maybe I can even take a look at Bitcoin because I just realized it's on here. But yeah, this was a markup from ages ago that I did. So I think March 11th was the actual date of it. And I don't know if you guys, so SM, Simple Markets Academy was my old mentorship, and I used to share similar stuff like different data, different analytics in there. And I did share that image. I'm trying to find it now. I'm like blanking. Here we go. So yeah, this image was my silver prediction from March 11th of 2023. And this is on the weekly time frame. And I'm just going to kind of dive into a lot of these different markups here and kind of understand why this prediction was made. But number two, kind of getting a better understanding of liquidity. Because I do think liquidity is one of those things that it really is the fundamental movement of the markets. And I think the more you can understand it and understand what's actually going on, the better you can apply it to either a higher time frame or just a better understanding of the charts in general. But so this was silver. Let's actually pull it up on TradingView. Might be a little easier here. So I'm gonna shrink it real quick, and I guess we can take a bigger step back here. But one of the first things I'll look at on the higher time frame like this, especially, and sorry if my voice is a little scratchy. I might take frequent water breaks. I'm not feeling too good today. But so we're gonna mark out this high, this low, and then this high here. And get an understanding that this is kind of the range that we're working within. And then price obviously makes its way down here. Now that I think about it, in 2011, I'm kind of curious why silver made such a great high. Let me check gold as well. Yeah, very similar actually in 2011. I'll have to do some research into that after because I'm not quite sure why silver made such a crazy run there. But one of the first things I noticed is my consolidation area. Hold on, I want to keep up with chat too, make sure I don't miss any questions. All right. So yeah, one of the first things I noticed was this consolidation area that occurred here as we reached the bottom of this range. So as most of you know, when we have a range low like this, we consider it our protected low, our strong low, whatever you want to call it. Doesn't necessarily matter. But as price approached it, we got within this consolidation range here. I'll mark it out in red. And all this essentially means, and why consolidation can be so important, is understanding that the highs of this range, and especially all of these lows of this range, hold a lot of orders. And let me move this over here so I can make sure I what's going on. And so basically all the orders at the low of this range, it's why I have it marked out here as resting liquidity. And the general idea is that when there's a ton of sell orders at the bottom of this range, or sell stops as it's known as, price will run through it and institutions can convert this into buying power in the markets. And it's kind of just the underlying reason why liquidity is so important, because they cannot make a move with such high volume without the orders present in the market. So for every $1 million of silver that needs to be sold, there has to be someone that wants to buy that order that they're trying to sell, and vice versa as well. So if you want to buy $1 million worth of silver, someone has to be selling it at the exact same price in the market. And that's just kind of fundamentally how liquidity works. But the other end of the spectrum is you can see how impulsive and strong this bearish move was through the resting liquidity that we talked about. And this is another thing that kind of goes back to the institutional involvement, and how if the institutions want to drive price very heavily bullish, they need to absorb and collect all of the sell side orders in the market first so that they have enough liquidity. And typically you're going to see this done with an extremely impulsive bearish move before that bullish move occurs. And then we have a break of structure to the upside on silver. You can mark it at this high if you want. You can mark it at this high. It doesn't necessarily matter. Just in general, understand that we have that break of structure up. And we have the mitigation that occurs here as price makes its way back down. So one of the main things to obviously keep in mind throughout this whole thing is we are in a weekly time frame, technically even a monthly time frame if you really want to scale this up, and look at it from the perspective of how most of us trade on the 4-hour time frame. But despite this looking a little complex analytically, I think one of the main things to focus on here is number one, we have a great liquidity consolidation area in a very impulsive sweep on liquidity with strong volume. And then we have a very strong break of structure and then a fair value gap as well. And then price makes its way to retrace into the range. So despite how analytically complex this might look, it realistically is the same thing that all of us trade with our swing trading strategy here, where you would slap the fib on and try to enter at the 75%. So it does have those same fundamental concepts that we use, which is liquidity, volume, the fair value gap, the breaks of structure. Everything was kind of present there. And then obviously price worked its way back down into this last bearish candle before the up move. For those of you who watched our supply and demand section, you'll know that this is basically just a demand zone at the end of the day. And demand zones need to get what's called mitigated. And all a mitigation means is that at this level in price, where they very heavily pushed price through this point of liquidity, and then a heavy bullish move after that, at this level where they began that sell momentum, if you think about it, they sold at $18 essentially here. So now that they drove price much higher to absorb these orders and they could use that to drive price much higher, they're technically negative on those positions that they initially sold off on. And so what you'll see a lot of times is institutions now will slowly bring price back down there because they're lacking liquidity at the moment. They'll bring price back down to that general area where they sold, because obviously if you are selling at 18 and now it's at, 29 is what it peaked at, they have to drop price towards that level where they initially sold. And then once they get down there, they're essentially breaking even on their positions and then can drive price higher again. And this is something very common you'll see occur just on a higher time frame basis or even on those lower time frames. But that's what the term mitigation essentially means, is they're closing out their initial sell orders that they had to use to then create the buy volume in the markets. And then obviously as they're working their way down there, very similar to this consolidation area over here, they have plenty of lows being put in place here. This is what many of you know as inducement. And inducement is essentially institutionally created liquidity. So they're intentionally creating these consolidation areas in these lows with the expectation that they can now create a bunch of sell orders in the market again, drive price through it like we talked about here, and then they can now use that to convert it into buy power and bring it to their next external liquidity point. So truly all that's happening here is just the fundamental idea that liquidity is the overall driver of the markets. So when price was at about this level here, it was very apparent to me that we were working within this low and this high. We'll call this our break of structure for now. And price came back down into this general sell area from the top of this candle or this bearish move to the bottom. And then as price approached there, we now see a shift in structure. I do know some people did ask me why I didn't wait for this point, and I think this kind of goes into higher time frame analysis a little more. If you have that higher time frame bullish expectation, you don't necessarily need to wait for this extremely conservative structure point. You can just focus on the idea that we had a low, lower high, lower low, and then obviously ended up shifting that high. So that to me, especially paired with being in a great higher time frame area for buys, kind of gave me the expectation that from this point, we would go and target the liquidity high. So that was back in, you see here, I think it was March. Check one more time. Yeah, so that was March of 2023. So actually over a year ago now. And that's another thing with smart money is, at least personally, I don't utilize it in any time format. So I had the expectation in March that price was going to go from this low or this demand zone to this overall target high. I can't sit there and tell you how long it's going to take. It's just not how I trade. Maybe some fundamental traders try to, or people who trade options and have time limits, maybe they're better at that than I am. But you could see overall, as we go to present day price now, though, we did eventually make our way from this point, never invalidated it, and then obviously made it up to our target high. So it does really just root in liquidity. I just wanted to show that higher time frame markup and explain kind of how I was thinking about that. Something very similar on gold as well. After this webinar, let me see. I don't know if I'll be able to find it right now. I don't want to start digging and waste time here, but I did end up calling this move out even before March. I think price was actually at this candle. So, oh no. Oh, wow. 2 years ago now. So March 2022. I'll dig up this clip after the webinar and send it in chat so you guys can see. But my analysis, it was actually in an old course content video from an old server I had. But once again, let's actually just stop price here. Once again, I had a very similar idea with gold that we were marking up higher highs and higher lows. Let's go to a weekly, actually. Might be a little easier to see here. And just marking up higher highs, higher lows all the way up. And the understanding that our last very impulsive bearish move was at this area here. And then price formed a higher high, taking higher time frame liquidity. So I did expect some form of pullback through all of this liquidity here. This is what most people would refer to as like a support zone. I'm going to keep moving chat over here to make sure I don't miss questions just in case. But this is what most people would refer to as a support zone. We had plenty of lows put in place here. So my expectation was that price was going to have to get driven through these areas here, or sell stops, and then come into this very aggressive bearish move, the same way we kind of went into this bearish aggressive move on silver. And then obviously after reaching that area, I expected price was going to go and eventually run the target high. So all I'm trying to explain here is just that understanding of fundamental liquidity. And if you can really start viewing a chart with that in the back of your mind, not only will it kind of improve your trading positions on the 4-hour and using the rules that we use, but it'll give you a better idea of things like liquidity sweeps, why they're occurring, how they need to happen, and things like that. And if you're constantly looking at a chart with that point of view, you're definitely going to see an improvement on your analysis for sure. And that goes for a lot of the people on the 4-hour time frame. When I go over their trades, I do notice they're not utilizing liquidity sweeps properly, or they might not be viewing them that great. So that's definitely something I want to talk about as well. Let me also briefly go over SPY. So one thing about SPY is this is the top 500 stocks in the US market, for those of you that don't know. And I do kind of want to talk about intentional liquidity sweeps in relation to news events as well, because some people think that news events are completely random, arbitrary events that occur and they don't have an effect on price, or they think that fundamentals control technicals, vice versa. But this here, for example, is what was known as the flash crash in the pandemic that we had. So this was March of 2020, right when COVID began. So the US market absolutely tanked. One of the largest and most impulsive crashes in a long time, negative 35% roughly. But one of those things, coming back to that point of liquidity, is it very intentionally came to this level and reached just below that, because as I talked about on silver, when price reaches below these consolidation areas or significant lows and highs in the market, these liquidity sweeps are happening because they need to convert these sell orders into buy positions in the market. So the same kind of idea here. In order for, this was actually also the largest up run in the history of the S&P 500 from here to here, over 120% in, I believe it was 2-year period roughly. Yeah, so just about 2 years, January 22. And in order for so much buy volume to be present in the markets, there needs to be a significant amount of sell orders to convert into buy positions. And you're kind of seeing that here with this liquidity sweep and why this flash crash, as they called it, came perfectly below this point of liquidity. As price is moving up, there's a lot of institutional investors or hedge funds that are entering this market. And when they do, they're putting their stop losses below these significant lows in the market, trailing stops as well. Very commonly, you'll see them below these very strong lows. And this one being the most previous strong low, price, when it needs to make a very substantial bullish move, but there's not enough liquidity in the markets, they have to now drive, the institutions being they, have to now drive price towards a point where there's a significant amount of orders resting, sell stops, and then they need to convert those into that buy pressure. So it's very, very intentional, despite it being something called like a flash crash in this event that was so unforeseen. It is written technically into the charts, as we can see here, and it just all roots into that general idea of liquidity. And then that also is kind of shown in the more previous area here, where people began to, they saw this very heavy SPY move, and instantly you're seeing headlines in the markets about the 2024 crash, and that the markets are beginning a crash. And at the end of the day, once again, as I said, very impulsively, because that's the key here, is understanding how impulsively these very bearish moves to grab liquidity are before they go and drive price higher. We could see the same thing occurring here, where they drive price very, very heavily through points of liquidity like this. As institutions or large money are trailing their stop losses in the market, they can now grab liquidity like this, but still stay within their general structural ranges here, and then very, very heavily drive price in the other direction, essentially leaving the uninformed traders, or in something like SPY, they're technically just misinforming the masses. All these news events, all these things telling people that the crash is beginning, causes these large sell-offs, causes people to sell off their positions, take profits, whatever it is, when in reality they're just kind of shooting themselves in the foot, because all these institutions are doing is using all of those sell positions to now fill their large buy orders. So if everybody in this call got scared of this 2024 crash that was going on, and we all put, let's say, pooled all our money together, and $100 million worth of sell orders went into SPY for us all, the institutions, at the end of the day, if they want to place their $100 million buy orders, they need the scared masses like us. They need people like us to be afraid, sell off large amounts of positions, and they can utilize those orders to now drive price bullish, which is where they want. And they're essentially capitalizing off of the fear, or the, I guess, lack of education of the masses. And it all is rooted in that general idea of liquidity. Fundamentally, that's all that's happening here, is that exchange of orders. And I do have two people today that mentioned I should go over their data. So the first one is Big Mac. I was actually just kind of briefly looking at what he has going on here, and I got to give you your props where it's due. I don't know, for those of you that don't know, Big Mac's 17, and he's far more disciplined, has far ahead of where I was trading at 17. So this is fantastic. 475 entries on an Excel sheet. I think he even converts it from FX Replay to Excel, which is just crazy. So he's killing it here. And I'm going to go over briefly the analytics section. And one thing to actually notice here is that slow improvement on the capital side. We're going to see it with the equity curve here in the analytics section, but starting at roughly 99,000 or 100,000, obviously the first one was a loss. So 99 is your initial value here. You can see it takes a dip down to 97, 96, 95. But overall, and of course that's going to happen, there's going to be these significant losing periods where some people look at this as a 5-trade losing streak. I think mentally the better way to look at it is a 3-trade losing streak. Or sorry, I meant 6, but a 3-trade losing streak here, and then 3 break evens. Break even, I don't think should be looked at as losses. That's something that I find people doing a lot, and just mentally it puts them on tilt as is. Oh, he said he's lagging. All right, yeah, I can also send the recording to you in DMs to Big Mac when I go over it. But one thing I was mentioning, starting at roughly 99 here, but if you do scroll all the way down to the bottom of the 457, despite significant losing streaks and a bit of a lower win rate that I think can have some improvement on there, some marginal improvement, you're looking at over 200% gain on this account, which is enormous. Bringing $100K to $234,000 is absolutely enormous. That's another thing that some people tend to forget, is something like the S&P 500 that we just looked at. Your average returns on that is about 8 to 12% a year, meaning you would turn 100,000 into maybe 108,000, comparative to something like trading, which unlocks the ability of 230% gains in, the time scale that this is, a few years, which is just massive overall. I don't even know if this leverages all the pairs, but we're going to look at the analytics section here. So these are the ones that I believe he has done. He specifically requested that I go over some of the trades in years with a 0% win rate. I guess I don't need to do this one because there was no trades on that one. So I'll look at Euro AUD and GBP CAD specifically. This here is also, I notice he says without break even for his total number of trades. So this is actually called your realized win rate, is what it's called. Realized is in this term here, and all that essentially means is if you are a break even or a risk-free trader, as I mentioned before, those trades being considered zero or null on the account doesn't necessarily affect your long-term data. So some people will say, hey, I have a 70% win rate, but they utilize break evens. So it doesn't necessarily mean that every time they enter the markets, there's a 70% chance they make money. So this realized win rate here is actually the raw win rate that every time he enters the market, this is the percent of the time that he can expect to make money, roughly 32%. Sorry, I want to make sure I didn't miss anything in main chat. I saw someone type a message. So overall, we talked about 428 trades, it looks like here, 104 winners. And the other thing to notice is this equity curve. If you take a point from here to a point from here, it's fantastic. There is some slower periods and of course deeper periods of drawdown, like you can see in sections like this, followed by crazy strong win rates to bring that right back up and over. But overall, it is a very consistent equity curve. I do think this win rate can be improved upon a bit, so I'm going to dive into some of his trades and kind of go over why I think that. Now, pound CAD, let's see here. So GBP CAD, I want to make sure this isn't Chef. Okay. So this ranges from about 2007 to 2023. I know he tests year by year, so it doesn't necessarily mean that he's testing, I don't even know what that is, 16 years span here. Sometimes, so I believe what I've heard him say in the past is he trades 2007, dives into that year, might trade 2021, dive into that year. So it's not that he traded 2008, 9, 10, 11 all the way up here. So it does jump around a little bit data-wise, but he had 4 break-even trades here, and what is this, 7 losing trades. So we're going to dive into some of these and see verification. Let's drag this over. So right out the gate, I see absolutely nothing wrong with this trade. That's probably going to be the consensus for most of these. I do feel like I briefly brushed through some of them, and they were great trades earlier. Doesn't necessarily mean that, how's this, $4,000 bonus? I'm all set. The only thing I will say about this position here, it's a little bit odd, is when this move occurred here and price retraced, I know the break of structure hadn't occurred yet, but when this retracement occurs and then another heavy bearish move, technically speaking, that is another possible setup there, where liquidity sweep occurred, break of structure, candle close. But otherwise, I don't think there's anything wrong with this one. You can even just see volume just tended to shift bullish and price wanted to reverse at that area. What year is this? Because I feel like I took this trade live. It doesn't say. It doesn't say, but I'm pretty sure I took this trade live, honestly. Let's see what else we got here. This is a break-even position. One thing about this one as well, so the main thing I try to focus on is most recent price. Let me make sure Discord's pulled up so I don't miss questions. So I try to focus on most recent price where my rules are met. So obviously you guys are all familiar, our rules of liquidity sweep, breaks of structure, fair value gaps. So yes, it did occur over here. We have a sweep on liquidity, a break of structure. We have the fair value gap here. But as price begins moving down, you can even see we have more setups that occurred. So number one being this consolidation range, very impulsive sweep on liquidity, then a break of structure higher. Is there any way I can draw on this? It's going to let me. Oh, God. I got default. Yeah, I'm all set with that. But we have consolidation area, very impulsive, bearish move, sweeping this liquidity in the consolidation like we talked about. And then a very bullish move here with a fair value gap left behind. So realistically speaking, at least for me, I would have been entered in a long position here from this specific low being my target. You can even see from this high to this low, if you draw out your fib, this would have been a winning trade, given that hopefully it comes and reaches the last remainder of this high here. So the only thing that I'm mentioning here is I definitely would not necessarily avoid these long drawn out positions, but if I do see a trade that meets my rules more recently, like this, for example, I would consider this more invalid and focus on what I'm seeing here, as well as just the very apparent bullish trend that we have overall here. I don't necessarily take the higher time frame into account, but I do think that taking the most recent trade setup that follows all of my rules into account is very important for me. Let's go into another trade here. This one, nothing really wrong with this. Definitely a bit of a larger trade than what I'm used to. Now, one thing I will mention here out of the gate, I've talked about this a few times where I don't want to call it an accident, but when you mark liquidity and this line is moving downward like this, you can see realistically if you took this line and you straightened it out, you're more likely looking at a general area of consolidated highs, especially this very sideways range. And as we know, if price moves down below a consolidation area and grabs that liquidity, more likely than not, the remainder of the liquidity is going to be at the highs of the range here. So I would just be a little bit more careful about drawing slanted lines in this direction, at least when referring to liquidity, because you could just be kind of, I guess, making something out of nothing when it comes to that liquidity sweep. Overall, though, I don't think this is a bad trade. Go to another break even here. This one I think is great. What's up with all these pop-ups? What the hell's going on here? TradingView's trying to sell me everything they can, but we got a great liquidity point here. Runs through it, break a structure, fair value gap. I think this one's fantastic. Break even trade, obviously. And another one. I see nothing wrong with this one. This is crazy. I'm about to like block these guys. What is going on? No idea. But anyways, another great liquidity point. Fair value gap, break a structure. Tapped in here, another break even. This one, not bad either. Is it, am I tripping? Is it because I'm opening a new link every time? So it's like, tells me something on every new link. The one thing I will mention here is, yes, this is a sweep on liquidity and maybe a bit of an internal break of structure. But when I'm seeing price very, very sideways here, I see a couple highs up here together, a couple lows down here together. We are range bound, and these trades are not bad to take, but you got to understand that they are lower probability when you do take them. I definitely try to avoid markets that are sideways like this because these things that look like a break of structure may not be a significant point in structure compared to some of the other trades that we've seen here. Like, for example, this one is clearly a significant point in structure. Price came up, and then we reversed here and had that retracement, and then we came through and broke it aggressively. Compared to something like this, where we didn't necessarily break any highs or lows with this low here, it's not too significant to overall structure, and that typically comes with these range-bound markets. It's much tougher to kind of distinguish, and I do try to avoid those as much as I can. Once again, nothing wrong here, just I would say it's a little bit of a range-bound market, but I do like to trade here. We come through this consolidation area, we break structure up, we form plenty of inducement before. I think this is a break even because he taps in, gets about 1.5 RR, and then back to the break even line. This one, great one as well. We have consolidation area, sweep through it, a couple small fair value gaps here to be honest, but break structure overall, and we're working within this general range. Price comes down into it, and it's a loss. Got two more to look at on this pair specifically here. Same thing though. I think this is a great one. This one actually kind of reminds me of, oops, not this one. Something I'm looking at live. Which one is it? I think it's AUD NZD. No, sorry. Euro GBP, where we have this high that's put into place, price comes above it, and then moves down with the fair value gap. I see pretty close similarity there to this one here, and I don't see anything wrong with this. Lastly, this one as well, I will say this one is iffy, and the only reason, going back to what I said about making something out of nothing when it comes to those liquidity sweeps, you know, this pip of a movement past a high or a low does not necessarily show a proper run on liquidity. Compared to what I'm seeing here is what many traders would refer to as support or resistance. This general resistance area, quote unquote, is just a bunch of highs that are generally on this level. And if you think about how institutions see a chart, they don't see, or even the retail traders, they don't see resistance levels as pip perfect points on a chart. They see it as a general area where price, quote unquote, bounced off of plenty times. So 1, 2, 3, 4, you know, and many of them would even consider this a fifth bounce, and they would be looking to short price here, which obviously, as we know, if the majority are shorting, you want to be long in the markets. But I do think one thing that can definitely improve win rate is avoiding these very minor sweeps on liquidity. And when utilizing the term minor, you want to understand in relation to institutions, we should be looking for these very significant, very impulsive runs on liquidity. Impulsive is like my favorite word. You're probably sick of hearing me say that. But, when I showed this silver move, for example, and all this liquidity, look how impulsive and aggressive this down move was, so they can convert those orders into buy positions extremely quick, extremely high volume, and the only people that can truly create a candle like this, especially on liquid markets like silver or anything foreign exchange related, are the institutions that are driving this price action. So it is something that can definitely help increase the win rate by focusing on those more aggressive and substantial liquidity sweeps, and especially trying to avoid these very small ones and considering them a sweep, because in more cases than not, you're going to be on the wrong side of price action. Overall, I think those are my only two stipulations with what I saw here. Is number one, focus on the more recent ranges that you're working with, as opposed to, for example, this one here. The most recent range that I'm working with that followed all of my rules is this one here. We had a sweep, a break, a fair value gap, and an entry, compared to holding trades like this for much longer than they might need to be. Obviously, this is a break-even trade. It's not a bad trade by any means, but I do think in the long term, if you focus on those more recent ones, you're going to see a better improvement on that win rate. And as we can see as well, his win rate is clearly profitable and great long term. One of the main things that I get asked a lot is, how do I increase win rate more and more and more? And it becomes almost this, I guess, addiction to driving your win rate higher and higher, which truly is just not how trading needs to be looked at. My win rate at this point does not really creep up too much higher. If I really wanted to dive into the crazy intricacies of my trading plan, I'm sure I could increase my win rate marginally by 3 to 5%. But if you really think about it, it's not necessarily, it's about peace of mind as well. Being able to comfortably trade your plan and essentially print money with it, in my opinion, is more important than diving into these crazy intricacies and trying to really drag that win rate up. Because at this point, if his win rate were to go from 32% to 35%, this equity curve would get substantially and exponentially cleaner. His win rate longer term would be exponentially nicer, and it's going to hover around that 35% instead of 32. But overall, the profit margin that increases from just a slight increase in win rate is more or not what the goal of most of you is. So it's not that his data here is bad because it's a 32% win rate, but I think if he brings that from 32 to say 35 or even 40, by making these small incremental changes of, for example, the things I've talked about with liquidity and what I talked about with more recent price, those incremental changes in your trading plan is what will drag your win rate up slowly longer term. And I don't think it's so important to try and do that over and over and over. There's going to come a point where your win rate essentially plateaus. And the only way to kind of increase it from there would be bringing in extra complexity into the plan, which I personally don't think is worth it. For some of you that really want to continue, and can, I guess, deal with that stress of that, it's perfectly fine. But your goal as a trader should really be to dial in on, can I drag this up a few points? Can I make these tiny incremental changes to drag that win rate up to a point where my equity curve might be cleaner? That's kind of how you should look at it, as opposed to some traders which feel the need to, that if they have a 32% win rate, they're doing bad, and it's the trading plan. A tiny little minor adjustment on the trading plan, like I talked about, is what's going to slowly drag that win rate up. So it is a patience game. Obviously, getting used to doing it on a live charts as well, dialing in on the psychological factors that might be dragging your win rate down slightly too. These things are all going to improve it long term. Let's X out some of these, and then I think the other pair that had a 0% win rate was Euro AUD that he had. Yeah, so Euro AUD, let's find it on this list, EA. So we're going to take a look at these. I was actually brushing through these ones before. No idea what that word means. 2020. Oh well, I don't speak Bulgarian. But once again here, I think this is a solid setup. Sweep on liquidity, break a structure, fair value gap. I see nothing wrong with this one. Let me delete this. This one, once again, goddamn. these pop-ups are killing me. This one, I would say liquidity sweep wise, maybe Going back to that thing I talked about making something out of nothing. We do, as much as you want to consider this liquidity so that you can take a setup, I think understanding that there's a lack of impulsiveness here, a lack of high volume, and really just spotting that there's equal lows here. So more likely than not, price might be attracted to grab that liquidity point there. But overall, not a bad trade. You can see, despite having this, even having a break-even rule in place, you can still break even on a trade, come out risk-free, and have the chance to make money, which is always a good thing. You're not losing money in the markets, but you had a chance to make money based on your edge. Let's see. This one isn't bad. Once again, I do think the time frame here, I don't like to hold trades for this long. If they're consolidating in very low volume like this for a long period of time, more likely than not, I found that they lose. Another thing here is, drawing liquidity like this it's not bad, but I think fundamentally understanding you have one high here, two highs here, and one that's relatively close, you're looking at almost triple equal highs here, and all that price did below this break of structure was just simply grab that low and then very impulsively move back into the range. Now, these are all a little bit of complexities, I won't lie. This is not something that I always look at in my trades, but when I'm really doing a deep dive on analysis and those incremental changes that can skew your win rate long term, I think these things can be important. So understanding that more likely than not, this break of structure was not very strong, and it just grabbed right below the low and then impulsively broke back up into the range, we can assume that liquidity at these lows are gone. And when liquidity at the lows of the markets are gone, and you think of liquidity as a magnet, it's going to drive price slowly but surely towards the remaining liquidity, which is going to be at these relative triple equal highs here. But I don't think, me saying these things and bringing these complexities into the setups does not mean that it's a bad trade, does not mean that you shouldn't take the trade. But overall, you got to understand before taking it that it is more likely than not a lower probability position. And the more that you can kind of dial in on, I guess, these slight discretionary ideas like this, or the incremental topics that are going to really increase that win rate, that's all your goal should be. So I'm not saying that this trade is bad. I'm just saying that simply on a longer term perspective, focusing on things like maybe a stronger break or maybe avoiding these relative equal highs that are resting here is something that in the long term could bring that win rate up from 32 to maybe closer to the 40 ranges. Let's see what else we got here. Did I already do this one? I did. Go to the fourth one. This one here I think is good. See nothing wrong with this one. Now, this is a good example of wicks are always great when showing impulsivity, that word that I've probably milked at this point you guys are sick of, but impulsiveness really fundamentally shows the volume that's within a candle and within liquidity sweeps, and seeing a wick is a fantastic sign of that because it takes a lot more volume and a lot more capital in the markets to create a wick than it does to create this massive move here. So you can actually see we have a consolidation area, a strong wick reaches below that, and then a very bullish high volume move after, showing that institutional involvement. You can even see a consolidation as well in another high volume move. So to me, it does look as if the institutions are on the bullish side of the market. And then obviously, inevitably, a loss here just simply based on probabilities. I think it's a great position. Let me take a sip of water here. I feel like I talk too fast and my voice is like giving out. Damn, it's already 1:40. All right. Let me make sure I got no messages either. Okay. So let's go to the next position here. This one also great. Market is relatively range bound here, but I do really like this sweep on liquidity compared to the ones I talked about before, where you can see a significant high, price reaches above that high, and then we reverse the other direction. I even have a trade that's very similar to this in trade images. If we go to swing strategy, example images, let's see. Did I not share it here? This one, I guess, is similar in itself as well, but we have a significant high put in place here. Price just wicks it, very heavily breaks the other direction, break a structure downward, and we just came back up for the 3RR. Relatively similar position we're seeing here. I like that one. Break even, same idea. I will say the break of structure here might be slightly weaker. The only reason I say that, I know I focus on a candle close, but sometimes if price just reaches above this high and you're seeing all these fair value gaps bearish and price is just reversing very heavily in the other direction, in more cases than not, it does tend to be a liquidity sweep and price is going to be driving lower. But overall, great position, follows all the rules, fair value gap is present too. And then we have another one here, which I would argue this is another iffy one. When you look at these lows here, they are relative equal lows. And when you look at all of these highs here that are considered a break of structure, this is a very, very strong point of liquidity in the markets. We have so many stop losses resting above here. And when price drives through it, more likely than not, this very heavy bearish momentum after is to continue driving this bearish trend lower. Just because of how much liquidity is here and also these relative equal lows. So going counter trend, I do favor, but I think I'd like to see a better sweep on liquidity here. And I can even show an example of that in one of my more recent winning trades I took, which was, where am I at? I think it was Euro. Oh, I'm on the weekly time frame. Yeah, here it is. So this was a good example of a more recent counter trend that I took. Marking my highs and lows using the highlighter tool, which I think is a great tool to do that. Mark your highs and lows out, just follow your general structure, and then you can see we actually shift structure here, and we have a great sweep on liquidity, very impulsive. Those wicks, like I talked about before, where wicks show very high volume, this long of a wick in the markets is even more substantial than that long of a candle. And the reason being is because this candle went bearish from here to here. In order to create a wick of this size, or even a candle of this size, price had to start here, it had to come up a little bit, all the way down here, and then close up again. And that is a lot of volume within this candle. And when we see that very strong volume, it shows clear institutional involvement, and we're on the right side of the banks. We have our fair value gap here, a great point of liquidity that we grabbed, and then a break of structure going counter to that trend. So I did end up taking the trade here, got tapped in, ran straight to TP, and then I even considered this another general area of liquidity with a break of structure. So I did have a second pending order right here, but unfortunately, oops, I have a 50 fib on there, not a 75. But unfortunately, it was a very, very close miss on my live account, so I didn't actually get tapped into the second one. But you can even see if I did, despite it being very close, we ran right to TP as well. So there were two positions in a row that were counter trend at the moment, but obviously now we are in a very more bullish trend. And you can actually see I have it set up on the same pair now. Same kind of idea. We're seeing a great sweep on liquidity here, and then a very bearish move down. Consolidation below the low, showing it's less likely a liquidity sweep and more likely a strong shifted structure. And I do expect price to come back up into here and maybe make its way down lower into this range. Now, I'm not a higher time frame person as much anymore. I do love marking out my higher time frames, but I don't use it in a trading sense. But one thing I want to keep in mind, if you can learn to view the fractals of the market, there is a great low that's in place here, because this low is the beginning that started this retracement. And as we talked about, these significant lows have a lot of liquidity below them. So what do the markets do? They reached right below that significant area and then very bullish right after. And we could see the break of structure here. And what are we seeing? We're seeing a liquidity sweep, a break of structure, a great low, a high, a great fair value gap. So what can I expect is, based on our trading plan on a fractal perspective, I can expect some form of retracement deeper into this range before we make another bullish move. Now, obviously, I don't go this crazy complex, or I don't focus on my fractals on a higher time frame when I'm actually trading, but I'm just letting you know that this position here, this bearish position, does kind of follow in line with what my higher time frame expectation would be. The only reason I don't do that anymore is I found it would sometimes scare me out of positions. And also I do have to adjust this. This just happened this morning, so technically my entry is going to be a little bit lower here, and I'll have to adjust that on MT4 after. But in general, I'm just trying to really get the idea across that this is happening on all time frames. So the same way that I saw a significant low in place and liquidity grab there and a break of structure to create my trade, my trading range from this low to this high, it's basically the same exact thing that I'm seeing on the higher time frame here, where we had a significant low. We grabbed just below it for liquidity, a break of structure, and that creates a similar trading range from this low to this high. So my expectation could be some sort of movement into here before a bullish run again. And it is all just fractal in that sense. I obviously don't trade like a weekly time frame, but I'm just kind of getting that point across so you guys can see that this is really occurring on every time frame. And it's something that can sometimes add extra confluence to your trade, but on the other end of the spectrum, can cause confusion or fear to enter certain trades. So these are the pairs I'm looking at. I am actually still in this one. Looks like it might be a loss fairly soon. I saw some people talking about they got tagged out here because of spread. It can actually save you from a buy position stop loss like this. So I am still in this trade at the moment. I'm not out. It looks like it is fairly close to stop loss though at the moment. I'm in this one as well, this Euro CAD trade. Been in this one for a while, a little too long now, but I'm just kind of monitoring it. Volume is very low. So yeah, I've been holding this one. I don't even know when. August 8th at this point. So not, I guess not too long. Maybe I'm just being dramatic. But yeah, so I still have this one. I'm in UChef as well. I have a Euro GBP sell here, and then I have an AUD NZD buy that I'm waiting on as well. I did see someone mentioned a pair last week. I think it was the Euro AUD. So this is one that I know a lot of people took as well. I didn't take this one personally. I honestly just didn't even really see it, but they saw from this low to this high. That one did just hit stop loss today. I heard some people talking about that. Is there any other positions that you guys are looking at? I can kind of check them over. I didn't see too much, but I can briefly kind of go through. I'm in GBP CAD also. Let's see. As in this sell position here. This is not something I saw as well, mostly because I don't really see a fair value gap here before the break of structure. I do see it down here, but most of my testing is based on the fair value gap before that break. But yeah, I'm not personally in this one. It's another thing when I've talked about it before. If price is running very, very far from my initial entry here, and the break of structure is way up here, for example, I tend to avoid these ones only because when I trade what I call range based, so a good example of a range based trade is we have a high, a low, and the break of structure is very close to where that high initially was created. This one, for example, we have a high and a low. The break of structure was just here, and I expect a retracement. As price gets further and further from that break of structure, and we just keep running very, very heavily, I think more likely than not, this is going to interact with something on the higher time frame that could drive price higher, come and clear out liquidity, etc. Could be whatever. So I don't have much experience in my testing based on holding trades for very long. I mean, even just zooming out from this perspective, I see we just grabbed liquidity at this low, broke structure higher. We have this range that we're working with, and more likely than not, this is what's going to happen just based on a structural standpoint. I don't use higher time frame in my analysis, but I'm just giving ideas of, what could possibly happen with this trade. It is important for you that the FBGs before the break of structure. I typically do. That's just what I tested. So honestly, I cannot tell you the expectation, like if it's after, if that has any real effect on the data, I'm not sure. But personally, when I was doing my testing, I focused only on it before the break of structure. That was just what I did at the time and collecting a lot of data. So I don't necessarily know much about if it's after or before and if that will have an effect, but it's just something that I personally focus on. Don't see much else going on here. Can you check NZD USD? Let's see here. Oh, I do think that's a good setup. Kind of similar to what I talked about before, though, where some people might mark this as a liquidity sweep, but when you got to keep in mind we are very close to equal lows here. But this is something I've seen plenty times in testing where we have a nice break, a nice sweep, and I do expect that could be a pretty solid setup there. I'll actually keep that one in mind. Usually I don't. If I miss them, I'll just let them be, because if I didn't see them and it didn't jump out right at me, then I'll leave them alone. But this one's got plenty of time. It just broke structure. So I do think that's a pretty solid setup. Let me keep that one marked up. Actually, let me just mark it up nicely so I don't have to scribble all over my charts. Break a structure up. I like to mark my low, my range high, and the high that structure broke. and then I have this here. Now, one thing similar to what I mentioned before about the other pairs is if this continues to just run bullish and bullish and bullish, I'm out. I don't like to just keep dragging this substantially when my break of structure is all the way down here. That's something that I found very often when price just keeps driving up and up. It can reach a pool of liquidity on the higher time frame or whatever it may be to then just drive price the other direction. So I don't like to hold trades too long when the volume is just crazy high like this. So if it goes any higher and just continues driving up, and I've talked about it before, my soft rule is if this 50% eventually reaches higher than the break of structure, so you can see what I'm talking about here, this line versus this line. If price just keeps going up and up and up, and it gets all the way up here, and that 50% reaches higher than it, that is kind of my soft rule for deleting orders. You can see, obviously, in some cases, I don't necessarily ignore it, but I don't focus on it as much because that did happen here on EuroCAD. But, you know, I'm kind of biting the bullet for it now because obviously I've been in this trade for much longer than I really wanted to be now. I don't see too much else otherwise. I was looking at USD CAD too, but it seems like it's running. Euro Chef. I did, yeah, so this is another example of that. I had Euro Chef as well, and price just seems to keep climbing and climbing. So this one is deleted at the moment. Oh, USD. Gotcha. Had this AUD CAD as well drawn out, but it's another one that just seems like it's kind of running. Break of structure under 50 level doesn't make it invalid. Definitely not. I know so many people who have sent me data and it works perfectly fine. It's honestly a personal preference of mine. I don't like when price just continues, like this one, for example. I have a break of structure here. If I were to slap this order on, price hasn't even attempted to come back here yet. It could just run and run and run. And, you know, I have a pending order with margin on my account locked up. So for those of you that don't know, I only trade personal capital at the moment. I don't use any firms or anything like that anymore. I am from the States too, so I'm kind of banned from all firms at this point. But I get my margin locked up because I do risk 2% per trade on my personal account, and it is very limited leverage wise. Here in the US, we're actually limited to 1 to 30 leverage. We're not allowed any higher than that on what's called a regulated broker. So I do have a very large account with my regulated broker, and it does help with margin. But risking 2% is also a significant amount of risk when working with a larger account. So I do have margin, I guess, issues when it comes to placing 5, 6 orders at once. Or in an example like this, having an order pending for a long amount of time sometimes can prevent me from even entering that due to margin and the leverage that we're kind of limited to here in the States. But the United States just likes to get the shaft from the government here. They, you know, we're banned from all of those simulated firms at this point. We have regulated brokers that are capped off on leverage, all sorts of garbage here. But that is something that I just kind of, it's a soft rule for myself, but it doesn't mean that a trade's invalid. I've seen so many examples of data that people have collected not using any type of rule like that, and it does great. But yeah, I don't really see much else. I'm going to probably wrap it up here too. It's 1:55. So any remaining questions you guys might have, drop them down in chat and I can go over them before I head out here. I'm going to take a water break too in the meantime because my voice is giving out. All right, if there's no final questions here, then I might wrap it up. I see a couple people typing. I'll give it a second. Wonder if USD Chef, I'll keep you guys updated on this one. It might end up hitting stop loss soon. And then USD CAD, keep you guys updated on this one within the next 3 years, hopefully, if this is going to finally make a move. Talk slower and drink more water. I know, I have been told I talk really fast. But there is one more person. He's not actually in the call at the moment. He asked me to go over his data. I ended up getting sidetracked or taking too long, so I'm probably going to go over his next week. For those of you that don't know, I mentioned Sven is going to be taking over my call on Friday. I'm going away this weekend. And obviously I'm taking over his call this week, so we kind of flip-flopped. But yeah, so you guys will talk to Sven on Friday, hopefully. And that's going to be all for this call. I'll have this uploaded probably within the next 15 minutes or so. So thank you all for joining. Had a pretty good showing, honestly, compared to the time that I hold my calls at. But all right, I'll talk to you guys later. Have a good week.